In this screencast series, I am going to review what we have learned thus far in this accounting class, beginning with our first introduction to basic financial accounting and ending with our introduction to accrual basis accounting and adjusting the accounts. There will be several screencasts in this series. I'm going to review these topics by way of a sample scenario or problem, which I will go through on the screen in Excel. Now, the particular problem I'm going to go through is a variation on problem P1-4B from the textbook Financial Accounting, the 8th edition by Wigand, Kiso, and Kimmel. And in this problem, we have Jesse Paulus, who owns a consulting firm, Paulus Consulting. And we are given the April 30th, 2014 balance sheet, which show the following balances. We have our cash, which has a balance of $4,000. Our accounts receivable have a balance of $1,500, and so on through supplies, equipment, accounts payable, common stock, and retained earnings. We also have all of these transactions that happened in the month of May. Now, this problem, it asks us to show the effects of these transactions on the accounting equation, and we are going to use this basic format. Now, the accounting equation, as we know, is assets equal liabilities plus shareholders' equity. I have it highlighted here in blue-gray. Just as a review, what is an asset? Assets are the resources a business owns. They're used to carry out business activities. So we have examples here of cash, which is certainly a resource of a business, accounts receivable, supplies, and equipment. All of these are resources a business uses to carry out their business activities. And there are certainly many other assets. We also have our liabilities here, notes payable and accounts payable. These are creditor claims against assets. They are debts and obligations. Basically, these are a business's IOUs. And then we have our shareholders' equity, which is sometimes called owner's equity or stockholders' equity. And our shareholders' equity is the total ownership claims on these assets. Now, first, all of our creditors get to claim the assets. Shareholders have a residual claim. Once all of these liabilities are taken care of, then the shareholders have a claim. So we are going to look at these transactions, and we are going to show how that affects our accounting equation. Now, I already started this by putting all of our beginning balances in our various accounts. So up here we have cash with $4,000, so I started with $4,000 balance. And you can see down below I have it adding up so that our total assets here are $11,000, our cash plus our accounts receivable plus our supplies plus our equipment. Our total liabilities are $4,200. Our shareholders' equity is $6,800. Liabilities plus shareholders' equity equals $11,000. So our accounting equation does balance. Now, all of these different transactions are going to have a dual effect on our accounting equation. It might be an increase in assets and an increase in liabilities, a decrease in assets and a decrease in shareholders' equity. It could be an increase in assets and a decrease in assets, but there will be a dual effect. So we will be recording each of these transactions in two places. We'll begin with May 1st. On May 1st, Paulus invested $8,000 cash in the business in exchange for stock. Well, in this transaction, $8,000 went into the business, and also $8,000 of common stock was added because cash was brought into the business in exchange for stock. So dual effect, our total assets have changed, our total liabilities and shareholders' equity have changed, and they still balance. May 2nd, paid $800 for office rent for the month. Well, we have paid money. That means that our cash has gone down by $800. Now, paying office rent, this would be an expense. And an expense, you can see the little minus here, is a subtraction from shareholders' equity. An expense is the cost of assets used or consumed in order to earn revenues. So in order to earn revenues in our business, we had to spend money, our assets, for office rent. We needed an office, so this is why it's an expense. On May 3rd, we purchased $500 of supplies on account. Well, this means we've got $500 more of supplies in our assets. But now we also owe money. That was on account, and so we owe somebody money. That's a liability. On the 5th, we paid $50 in order to advertise in the county news. That means our cash went down, we paid that. And advertising is another expense. It's one of those using assets in order to earn revenues. On the 9th, we received $3,000 cash for services provided. So on the 9th, we received $3,000 cash. That went up. And we provided services. When you provide services, that's a revenue. Resources were generated from a company's business activities. We did our business activity. We got resources, which were cash. So our revenues just went up. Again, you can see our total assets still equal our total liabilities plus shareholders' equity. Now, on the 12th, declared and paid a $700 cash dividend. Well, that means that our cash went down $700 and we paid a dividend over here. That means we distributed money to our shareholders, which again, you can see the minus, it's a subtraction from shareholders' equity. On the 15th, performed 3,300 of services on account. That means we performed our services, but we didn't get any money for it. So somebody owes us money. And when somebody owes us money, that's an accounts receivable. So again, that is a revenue. We performed our service, and so we get the revenue of $3,300. On May 16th, we hired an engineer at a salary of $5,000 per month, effective June 1st. Now, this actually isn't a transaction that is going to be recorded because it's not a monetary transaction that we can record at this point. We've hired an engineer, but that engineer doesn't start until June 1st, so we're not paying the engineer any money, and we don't even owe the engineer any money at this point. So there isn't any sort of journal entry or record that we need to take at this point. On May 17th, though, we paid $2,100 for employee salaries. That is cash that goes down, and paying our employees is an expense. It is part of doing business. Now, on the 20th, we finally paid for the supplies we purchased on account on May 3rd. So we paid for something with cash on May 3rd. We bought $500 of supplies. So now we paid for them. And now we don't owe that money anymore. So that accounts payable, that IOU, is going down also. So we decreased our assets and we decreased our liabilities, and we still balance. On the 23rd, we received a cash payment of $2,000. So we got $2,000 cash, and this was for services provided on account on May 15th. So if we look back at May 15th, we performed $3,300 of services. Now we've been paid for at least $2,000 of it, but that means that we are no longer owed that $2,000. We borrowed $5,000 from the bank on the 26th. That is an increase in our cash because we got money from the bank, but now we have a note. We owe money to the bank. So that is an increase in our liability. On the 29th, we purchased office equipment for $2,300. We did that on account. That increases our accounts payable. And finally, on the 30th, we paid $150 for our utilities, and that is an expense. We will continue this in the next screencast.